Alright, greetings. We're going to go through a series of slides somewhat quickly. These will be posted to Canvas so you can read some of them that I skipped through there. And the purpose of this is somewhat to help round off the inbound taxation concept that we've been learning about, talking about foreign individuals coming to the United States. What I want to point out on slide number 1 is to make sure you've got this dual status concept down pat, dual residency. And you can look through the various examples here, but let me describe what it is, this dual status first. We've talked about it before, but I just want to make sure you've got it. Dual status means that part of the year you are a non-resident and part of the year you qualify as a resident. And the tax compliance rules and the tax rules are different for these two people, so the result will be that there'll be one tax return for the non-resident status and a different one for the residence status of the resident. So the dual year or the dual status simply means you'll have two tax returns in 1 year, 1 calendar year, which is a little bit unusual, but that's then the rules. So that's what it means when we refer to it as dual residency status. Okay, and so on the handout, which will be on Canvas, go through and see if some of these if you don't recall some of these examples that we mentioned in class, and see how they wind up causing the year to be part of the year as a non-resident and part of the year resident. Number 6, I think when you look through it, you'll agree that this is one where you actually were a resident in the first part of the year, and then somewhere during the course of the year you become a non-resident alien. And it says because you permanently leave the United States. So how could you permanently leave? Well, there's probably a couple ways that happens, but the one that I know about is you get kicked out of the country and you'll become a non-resident alien right away. Okay, we talked about the first year choice, and what I want you to do is use the slides as a way of going back and refreshing your memory or getting it. The textbook certainly goes over it, but we have an example here on how the first year choice works. It's kind of important, as we'll see when we get through some of the other slides here. I'll point it out when we get there. So here's an example of residency rules. Again, this is a repeat of what we've gone over and over, but it's good because a lot of people practicing this area don't have this fully ingrained, and it's really crucial if you start doing tax planning to have when a person's a resident on the substantial residence test, have that in order. Real important to know. This gets you into some filing, by the way, this particular slide, which continues example 2. They meet the dual residence status, and this tells you that what kind of forms they file. If this, in this case, if it looks like he made the, he'll file a dual status tax return in 2010, which he'll be filing a 1040 NR for non-resident, and then the regular 1040 or EZ, as the case may be, in the rest of the year 2010. So the rest of the year would be a 1040, either a regular or an A or an EZ. And by the way, there is a 1040 NR EZ. And these are just tax returns that, like it says, easy. It's easier than the regular return because it has less forms, and it's, if you qualify, you have to qualify to use the EZ forms. Here's again another example which will be worthy of going over on your own to see if you follow it. Make sure you follow 100%. And this gets into some new rules which you have to look in your textbook regarding having been an F1 student and then coming in under a different exemption, J1. The two do not, they do not allow you to use the 2 in certain situations, so you'll have to see how that works out. It continues example 3, and then And that's example 3. So those are good examples to read through. Check your textbook for the rules, and if you don't see it in there, see if you can't understand it from the slides, or just ask me a question on it. Okay, so this gets into the differences between a resident and non-resident for tax purposes. For example, resident aliens have exemptions, but when it comes to a non-resident alien, then we're going to see that they don't. They can only claim certain exemptions. So non-resident aliens, they get taxed just the way as regular U.S. citizens. So this is a happy face because they get all the same deductions. And here, with a non-resident, I know this is terrible. It's not so happy because they can only claim certain exemptions, deductions, and then it has to be related to any effectively connected income. That makes sense because we learned with FDAP there are no deductions and it's a flat tax, flat 30% tax. So this statement should now make sense to you. And there's some other rules specific to non-residents, and let's see what they might be. Now this gets into some of the personal exemption. The non-resident alien can claim themselves, so they get that exemption. That's good. If you don't remember this from Tax 1, that's an indication you haven't been doing any tax returns since you took the course. That's what that means, which is okay. You can go back, and if you don't remember what an exemption is, a personal, you can look back. But at least a non-resident can get their own exemption. If they're engaged in a trade or business, then they may be able to claim the spouse. But notice that it has to go together. Again, under the theory that if it's FDAP income, there are no deductions. So if they're in a trade or business, you should remember from the class we just had the other day, that brings this income into what we call ECI, effectively connected income, allowing for other deductions. And in this case, exemption for a spouse or dependent. And it's only if you meet these tests, so it's really rare. It applies only to Mexico and Canada. It has to do with the treaty with those countries. So you can read through on your own some of the requirements. And South Korea somehow got into the mix with their treaty, allowing for spouse and children in some cases to be claimed. And then we have an example that you can read through. Here's some big exception for India. And again, a treaty exemption. And treaty exemptions, to take them, when you do a tax return, you're going to have to file the tax return in such a way to alert the government you're taking a treaty deduction or a treaty exemption or a treaty advantage, and the instructions will be there to tell you how to show that on a tax return. Here is you remember the adjusted gross income? That's what the line refers to. So above the line are deductions for adjusted gross income. Itemized deductions are from adjusted gross income. That's 2. It brings it for adjusted, and this is after. And you can see non-resident aliens can claim the same ones as long as it's related to effectively connected income. There you go again, ECI. With FDAP, it's a flat tax. So you must have ECI in order to get these above-the-line deductions. The below-the-line deductions, non-resident aliens can claim certain itemized deductions. Again, only if, it's really cool, it's only if they have effectively connected income with a U.S. trade or business. And these are some of the deductions they can get. And so you can look through that list and try to remember what, if you remember these itemized deductions. Non-resident aliens cannot claim a standard deduction. They would have to itemize because they cannot take the standard deduction, except, there's always an exception, under the treaty with India. And again, you'd have to file the form in such a way to show that you're claiming the treaty exception. Not tax credits, non-resident aliens can claim certain ones. Again, only if they receive income effectively connected with the U.S. trade or business. And those credits are, amazingly enough, the foreign tax credit, which is really not amazing, it makes sense, it has to be there to protect them from income that might be taxed in their home country or some other foreign country. This is a little bit unusual to think about it, child dependent care, but if they have to spend money to help both spouses work, they get their retirement savings, child care. And these things are not things you would remember outside of this semester, but when doing a return, the thing to remember is, I think the way to remember it is if there is ECI and you're a non-resident alien, then it should just automatically say, well, there might be some deductions because ECI allows for deductions. So now we know that it allows for deductions, but not necessarily only business deductions. Could be some personal deductions or exemptions, itemized deductions, but not the standard deduction unless you're from India, which is here, up there. Okay. Payroll tax considerations. Pay attention to this because we have in our class certainly a bunch of F1 people, and this may affect you. If you work in the United States under your visa, and the services you work for are for what your visa allows you to perform, then you're not subject to the federal unemployment tax, which doesn't come out of your pay. It comes out of the pay of the so the FUTA tax doesn't come out of your pay, but the employer pays it. But if you're a non-resident alien, you should be letting the employer know you don't have to pay it, or they don't have to pay it. Social Security is what FICA is for. And again, you should have had this in Tax 1. It's composed of two parts, Social Security and Medicare. And F1, as well as a couple of these other visa people, do not have to pay the Social Security and Medicare taxes. So that shouldn't be withheld off of your paycheck if you're getting paid. And it also applies to, you notice down here, circular practical training, which I don't know what that is exactly, but it has something to do with you foreign students. I think it has to do with when you have 1 year or the first year after your graduation, something like that. At any rate, you may know it better. But here's the deal. If an employer takes the Social Security taxes out of your paycheck, it will be wrong, and you have to file Form 843 along with an 8316 attachment so you can get the money back. You should also try to make sure that the employer is not taking it out erroneously to avoid having to do this. But if it happens, this is what you do. So you can get the money back because you weren't supposed to have it withheld. And that's wonderful. All right, and let's see what we got here. That exemption from Social Security does not apply to the spouses or dependents if they're on a J2 status, because they're not exempt. Okay. And there might be some exceptions to that, so you have to read through that. Number 8, exempt scholars, trainees, teachers are also exempt from the self-employment tax. And as it says here, that's really cool, except usually they're not allowed to be self-employed, so it wouldn't matter. Okay, that sort of wraps up what I want to do with this area of compliance for foreign professionals, foreign students, foreign teachers coming into the United States, issues that they may come up across while still being under the status of a non-resident alien before they become a resident alien. But remember, these last couple of slides only relate to non-resident aliens. Once you become a resident, you're subject to all and every ounce of tax that I am. So and all other citizens and residents of the United States. Okay, thank you.